this is an iHeart podcast. Guaranteed human.
With no fees or minimums on checking accounts, it's no wonder the Capital One bank guy is so passionate about banking with Capital One. If he were here, he wouldn't just tell you about no fees or minimums. He'd also talk about how most Capital One cafes are open 7 days a week to assist with your banking needs. Yep, even on weekends. It's pretty much all he talks about, in a good way. What's in your wallet? Terms apply. See CapitalOne.com/bank. Capital One, N.A., member FDIC.
You see it instantly. It's Coldwater Creek, the mark of exceptional workmanship and signature touches inspired by a Mountain West heritage. Distinctive styles created from quality fabrics, silhouettes perfected with just the right drape, feel-good fits offering ease of movement, and thoughtful details to elevate your look. Coldwater Creek's authenticity is embodied in every piece, embracing its confident spirit that carries through to today. Discover Coldwater Creek clothing, designed to fit your life the way you want. For a wardrobe you can count on season after season, visit coldwatercreek.com. Shop the new spring collection at 20% off $75 or more with code IHEART20.
Brought to you by the reinvented 2012 Camry. It's ready. Are you? Welcome to Stuff You Should Know from HowStuffWorks.com.
Welcome to the podcast, located from deep within the bowels of HowStuffWorks.com headquarters. It's Josh and Chuck. Say hi, Chuck.
That makes it sound really fancy or creepy or something. I don't know. I like it.
I was going for creepy.
Okay, I'll take it.
Did it work?
I'm creeped out, yeah.
Okay, good. Chuck, did you look out the window today at all?
I have.
Did you notice that everything is spinning very quickly clockwise?
I have.
You have?
That,
yeah.
Yes.
Do you know what that is?
A downward spiral?
It is. It's the U.S. economy circling the drain very quickly and taking the entire nation with it.
It's pretty bad.
Have you heard about this economic downturn?
Yeah. I mean, you can't miss it, man. It's everywhere.
It is. It is popping up everywhere. Huge investment banks that had weathered the Depression are starting to go under.
I know.
There's all sorts of financial groups that are suffering as well. AIG, the largest insurance company in the United States, who insures all these people, is going under.
Right. Well, now it's owned by the government almost completely.
Correct?
Yeah.
Well, 80% stake, 79.9% stake is owned by the federal government. Owned by you and I. We own part of that.
I feel it. I feel it in my bones.
I know. Don't you feel richer? I noticed you're wearing your top hat and monocle today.
Right.
Very appropriately. So all this stuff is going on. Yeah, it's impossible to miss it. And the crazy thing is that all of it can be traced back to a single thing, a single investment instrument that caused all of this problem.
Right. And I was happy to learn this.
You know what it is?
Yeah, I'll go ahead and it's called a mortgage-backed security.
Yeah.
And you're kind of the expert. I want to go ahead and preface this by saying that Josh wrote these articles, and I'm an economic idiot, basically. So I learned a lot by reading them, and hopefully people will learn a lot by listening.
Oh, I learned a lot by writing them.
I
bet. If people learn a lot listening, then it'll be a trifecta.
Perfect.
Everyone will have learned. So, yeah, what we're talking about today are subprime mortgage-backed securities. There's different kinds. Some mortgage-backed securities are worse than others, and the worst of the bunch are subprime mortgage-backed securities.
Right. Well, go ahead. I think the raw definition probably would get people interested.
Get their juices flowing?
Yeah, right off the bat.
So basically what it is a mortgage-backed security is an investment tool that is based on a pool of mortgages. So you take Chuck's mortgage and our producer Jerry's mortgage and, everybody at How Stuff Works mortgages. You pool them together and then you divvy them up into basically shares of all this one single pool of mortgages.
Right.
And as long as everybody, like Jerry and you, Chuck, are paying on your monthly mortgage payments,
sure,
everything's fine.
Right.
They're like dividends. It gets distributed across the shareholders of this pool of mortgages, and everybody's happy.
Right. Well, who are the shareholders, though?
They're the people who bought these mortgage-backed securities.
Which are banks larger than the banks.
It can
correct?
be anybody. It can be anybody. Yeah, what you're talking about is the process of how this works.
Okay.
So what I just said, that's a mortgage-backed security. You could purchase a mortgage-backed security.
No way.
You if you wanted to, you could.
Sure.
And actually, ironically enough, because these mortgage-backed securities are based on mortgages, and because they've been so divided up and repackaged and repurposed, we'll get to that in a little bit, it's actually possible that if you have like a 401k or you invest in a mutual fund or something like that, you may actually own a share of your own mortgage.
Right. I read that in your article and I was blown away.
Isn't that cool?
Yeah, cool. I don't know.
Well, it depends.
Weird.
If the economy's in the tank, then yeah, it's not good. But
Sure.
yeah, it could be cool if you're making money off of your own mortgage. You're
Right,
paying
true.
it back yourself.
Right. That's a positive outlook.
Kind of, yeah. So what you just mentioned, Chuck, is how a mortgage becomes a mortgage-backed security.
Right.
So, say you go in and you get a mortgage, you go through all the rigmarole, and they issue you a mortgage. The bank, when mortgage-backed securities were hot, would turn around, put it together with, several other of their mortgages that they'd issued that day, and turn around and they sell it to an investment bank.
Right.
Okay? An investment bank takes your bank's mortgages and some other bank's mortgages and pulls them together even more. So now you have several hundred different mortgages, and all of a sudden it's a single mortgage-backed security.
Right.
And then they start selling shares. The investment banks start selling shares, and then the investors, your mutual fund manager or somebody at J.P. Morgan Chase who's looking for an investment, they buy these shares and they start collecting the dividends. So that's how it works, right? Okay.
It's actually a lot simpler than I thought.
It's very, very simple. Like if you look at it, it's a very basic method of investing.
Right.
But it was completely and totally radical when it came about.
Sure.
I think it was the late 90s when they first really hit the scene, maybe early 21st century. And here's the thing. It's a really safe way to invest as long as, the housing market's going well, the economy's doing well, and people are making their monthly mortgage payments.
Right. There were rich times there for about a decade, probably.
Right.
In the housing
And
business.
it was based on that housing boom was keeping mortgage-backed securities. It was making them perform well.
Right.
So because of that interplay between the housing market and mortgage-backed securities become this hot commodity on Wall Street. Everybody's buying them. Everybody wants them. They're just great.
Right.
It's money in the bank, right? The problem is that demand created a situation where we needed more mortgages.
Exactly.
So, basically say, you're a good prime borrower. You're somebody who, based on your credit rating, your credit history, your employment history, that kind of thing, you pose little risk of defaulting on your loan.
Right.
There's a finite amount of prime borrowers in the United States.
Right.
And after a couple of years with the mortgages being pulled together and put into mortgage-backed securities, this pool of people dried up.
And then I know what came next was the subprime market.
Yes.
Which is a big reason why the housing boom, the bubble burst.
Exactly.
Because subprime borrowers, a lot of people think that subprime has something to do with the rate, the interest rate. It's a below prime rate.
That's what I always thought as well, but no, it
Right.
refers to the borrower.
Exactly. It's people that don't have enough income or the right credit. Basically, they were just writing things, it's kind of like a blank check, a false market almost.
Very much, very much. So, but when banks change their lending practices to include subprime borrowers, all of a sudden there's this huge untapped pool of people who can create mortgage-backed securities, because you can't have mortgage-backed securities without mortgages.
Right.
So basically, to answer this clamoring for more mortgage-backed securities on Wall Street, banks had to start issuing more mortgages. And the investment banks were more than willing to buy all these mortgages no matter what.
Right.
So your local bank that you go to, say you're a subprime borrower, and subprime has this really evil connotation here in 2008.
Yeah, it does.
But really, if you think about it, it's just somebody who has a credit score maybe below, I think right now it's 630.
Right.
It could be 629
Right.
and you're a subprime borrower. Or maybe you've even changed jobs in the last year. That could make you a subprime
Sure.
borrower. There's a lot of factors. It doesn't mean like you're this, nefarious drug dealing cat burglar who
right. You're not
taking the bank
drawing
for a ride.
welfare checks and swindling houses out of banks.
Exactly. Right. Necessarily. Some have, but for the most part, it's you can't really categorize these people beyond their credit score.
Right.
Hey, everybody, get this. LinkedIn has grown to a network of over 1 billion professionals and 130 million decision makers. And that's where it stands apart from other ad buys.
Yeah, for sure. You can target your buyers by job title, industry, company, role, seniority, skills, even company revenue, so you can stop wasting budget on the wrong audience.
Yep, that's why LinkedIn Ads generates the highest B2B ROAS of all online ad networks. Seriously, all of them.
And get this, if you spend $250 on your first campaign on LinkedIn ads, you get a free $250 credit for the next one. Just go to linkedin.com/SYSK. That's linkedin.com/SYSK. Terms and conditions apply.
You see it instantly. It's Coldwater Creek, the mark of exceptional workmanship and signature touches inspired by a Mountain West heritage. Distinctive styles created from quality fabrics, silhouettes perfected with just the right drape, feel-good fits offering ease of movement, and thoughtful details to elevate your look. Coldwater Creek's authenticity is embodied in every piece, embracing its confident spirit that carries through to today. Discover Coldwater Creek clothing, designed to fit your life the way you want. For a wardrobe you can count on season after season, visit coldwatercreek.com. Shop the new spring collection at 20% off $75 or more with code IHEART20.
So the banks, since they're no longer hanging on to the mortgage, time was, you went to a bank, you got a mortgage, that sat in the bank's vault, that piece of paper did, and you made monthly payments to the bank, and they took it in, and then after 30 years or whatever, you made your last payment, and they sent you your mortgage.
Right. And they did a lot of investigating into your history at that time because they were the ones, that had the most to lose.
They were carrying all the risk.
Exactly.
If you defaulted on your loan, that bank took the hit, and that was it. It ended there.
Yep.
Right? With the subprime or with the mortgage-backed securities, that all changed. Banks no longer had any risk whatsoever.
Right.
They would almost literally issue you a mortgage and possibly that same day turn around and sell it.
That really explains it.
Yeah.
There in a nutshell.
So whoever ended up with this mortgage in whatever form, whether it was a mortgage-backed security and it was divided among like 50 or 100 or 1,000 people,
right?
Whoever ended up with it in the end assumed the risk. So these investment banks didn't necessarily carry the risk either. The risk of you not paying your loan went to the individual investors, right?
Right.
Since all of these mortgages started to become based on subprime mortgages, all the mortgage-backed securities became based on subprime mortgages. When the foreclosure started, the market almost immediately plummeted.
Right, because it was directly tied.
Yeah.
It wasn't a trickle-down effect. They were directly linked.
There is another instrument, too, that were based on mortgage-backed securities, all right? So think about this. You have a mortgage. It's turned around, sold, packaged with some other mortgages, and then divided into shares. Mm-hmm. Those shares can actually be divided further and repackaged into something called collateral debt obligations.
Right.
And some of these can be based on all sorts of different things. You can take just mortgages from a mortgage-backed security and that will all mature in 5 years, or that are all interest only, or that are all fixed interest. There's all sorts of ways to package it. But one of the hottest items on Wall Street for collateral debt obligations were these instruments that were made exclusively from subprime mortgage-backed securities. Because you're a subprime borrower, you get a higher interest rate.
Right.
So the security, the investment on whether or not you're going to repay your loan, it's riskier, but the dividends are higher because the interest rate is higher.
Sure, and not unlike a lot of just the regular Wall Street stock market stocks, great risk equals great reward.
Right, and that pays off, but really if you look at it on a long enough arc, it never pays off. It always goes under. So what you have now is a bunch of people playing hot potato.
Sure.
With these things.
Were they short-sighted or were they?
They were greedy.
Greedy.
It's as simple as that.
Was it a live for now type of thing? Did
Yes.
they plan on dumping these?
I guess I would assume yes that once people started realizing, wait a minute, eventually when you follow these down the line, you're going to get to a house, and that house is basically its value is in this situation based on whether or not the person's making payments.
Right.
And we're betting on subprime borrowers making payments, and if they don't, this security tanks and we lose all of our money. Someone somewhere down the line around, say, 2006 figured out that these things were going to tank because of foreclosures, and that's exactly what happened. So it started this domino effect.
Well, who's at fault here? Or is that even important? I mean, was it... Or I guess everyone kind of shares in the blame. Because the homeowner that really doesn't have the money shouldn't go out and try to get the house. The lender, certainly, they were making the commissions, correct? The mortgage brokers.
Sure.
So they were making money and then selling them immediately. Or actually, I think the mortgage lender, it immediately goes to the bank. So they're not even really tied to the bank necessarily. And then the bank sells them, and it seems like the more it gets spread out and split up, the more fractured it gets. It's really hard to even tell who's to blame anymore.
It is. And, I mean, ultimately, finding the person to blame isn't going to help anything now.
Exactly.
But it kind of eases the pain a little bit, or at the very least you have someone to direct your ire to.
Well, I know in an election year, though, a lot of people are looking to point fingers. If this was not an election year, it'd probably be going down a little bit differently.
I think there's a lot of people to blame, as you said, and I don't think it's just the lending industry or the investment banking industry. And I don't think it's just the people who
Joe
took out
Six-Pack
huge,
homeowner.
Yeah, or the hockey moms. Don't forget them.
Right.
I don't think it's the average subprime borrower who took out a loan larger than they can afford.
Right, because they were sold a bill of goods oftentimes. Because I wrote an article on subprime mortgages, and a lot of people didn't even know what they were signing. These mortgage lenders would kind of use tricky dialogue to get them to sign on the dotted line so they could make their commission. So.
Yeah, there was a lot of predatory lending going on, big time. So regardless of who's to blame, these foreclosures start happening. And they start happening big time, widespread, all over the place, right? And like I said, it starts this domino effect. The weird thing is new houses that were being constructed stopped being sold as quickly because all of a sudden they had to compete with these foreclosed homes on the market.
Exactly.
That were maybe half price.
Yeah, I bought my house in foreclosure.
Yeah, I mean...
And this was even before the big foreclosure bust where they were all over the place. So we just got kind of lucky. But, yeah, all of a sudden these new houses are sitting empty because, like you said, they can't compete with a house that's 40% discounted.
Right. So all these foreclosed homes have this effect on the market, the housing market.
Right.
Right? More homes on the market means that the new homes aren't being sold because the foreclosures are going, it's like a fire sale out there in real estate in the U.S. But the presence of more homes on the market, the presence of more anything, the more supply, the lower the price.
Right.
So housing prices drop. So you've got people all of a sudden who are like, wait a minute, I'm in this huge, terrible, maybe hybrid ARM, adjustable rate mortgage.
Right.
And all of a sudden they owe more on their house than it's worth.
Right.
How long are you going to stick around? When are you going to leave and start renting? So foreclosures keep going and going and going. And as this wave of foreclosures takes over the U.S. housing market, it also directly impacts the investment market as well.
Right.
Because everybody was, so heavily invested in subprime mortgage-backed securities.
Right. And then you have the construction companies who own all these houses that aren't selling, so they have to lay people off, and then it leads to unemployment. It's a huge domino effect.
That's exactly right. Everything pretty much in the modern economy, in the global economy, in the U.S. economy, everything is interrelated, precariously so.
Right, but it all goes back to mortgage-backed securities in this case.
That's exactly right.
Whose idea was this to begin with?
I don't know. I've never found that out, and I've actually looked. I think that they are laying low.
There's got to be a dude. There's one guy who had this idea.
Yeah, well, there's a lot of financial instruments that are out there, and they come out of places like Harvard Business or Wharton School, and among other places. And they're modeled, that you can run them through an economic model, but it's really just a model. You can't really tell what kind of effect it's going to have until after it's introduced in the market.
Right, in the real world, it's a little different sometimes.
Right, and there's no, as far as I know, there's no regulation over introducing a financial instrument to the market. We regulate whether or not you can introduce a non-native fish into a lake.
Right.
But nobody's, watching over the financial instruments that are
Right.
being introduced to the market, right?
Right.
So I'm thinking basically if we had regulation of that, if things were tested out on a small scale first before being released en masse, that could be helpful.
Sure.
I think there's a whole lot of regulation that could take place.
Well, maybe these guys should start listening to Josh Clark.
Yeah, I guess. This is a pretty dense subject. You agree, Chuck?
It's dense, or I'm dense, one of the two.
I don't think you're dense. It is. It's a very dense subject. I would recommend anybody listening to this podcast going on to HowStuffWorks.com and typing in "How can mortgage-backed securities bring down the U.S. economy?" And stick around to find out which 4 articles Chuck and I consider essential reading right now. So, Chuck, 4 articles, essential reading.
Right, I'll say them because I know you're shy. They're all articles that you wrote, and they're really great, in-depth articles, and they are about the 4...
Hey everybody, get this. LinkedIn has grown to a network of over 1 billion professionals and 130 million decision makers. And that's where it stands apart from other ad buys.
Yeah, for sure. You can target your buyers by job title, industry, company, role, seniority, skills, even company revenue, so you can stop wasting budget on the wrong audience.
Yep, that's why LinkedIn Ads generates the highest B2B ROAS of all online ad networks. Seriously, all of them.
And get this, if you spend $250 on your first campaign on LinkedIn ads, you get a free $250 credit for the next one. Just go to linkedin.com/SYSK. That's linkedin.com/SYSK. Terms and conditions apply.
You see it instantly. It's Coldwater Creek, the mark of exceptional workmanship and signature touches inspired by a Mountain West heritage. Distinctive styles created from quality fabrics, silhouettes perfected with just the right drape, feel-good fits offering ease of movement, and thoughtful details to elevate your look. Coldwater Creek's authenticity is embodied in every piece, embracing its confident spirit that carries through to today. Discover Coldwater Creek clothing, designed to fit your life the way you want. For a wardrobe you can count on season after season, visit coldwatercreek.com. Shop the new spring collection at 20% off $75 or more with code IHEART20.
Candidates for president and vice president for this upcoming election. So we have how John McCain works, how Obama works, how Sarah Palin works, and how Joe Biden works. And I haven't read the Joe Biden one yet, but I'm hoping there's something in there about his teeth.
Nothing about his teeth. A lot about his foot and mouth condition.
Right. Well, if there's room in that mouth for a foot from all those teeth, then hats off.
He does have amazing teeth.
They're great. I need some choppers like that.
You can check all 4 of those out by typing in Joe Biden, Sarah Palin, Barack Obama, John McCain, any of them, in our wonderful search bar on HowStuffWorks.com.
For more on this and thousands of other topics, visit HowStuffWorks.com. Let us know what you think. Send an email to podcast@HowStuffWorks.com. Brought to you by the reinvented 2012 Camry. It's ready. Are you?
You see it instantly. It's Coldwater Creek, the mark of exceptional workmanship and signature touches inspired by a Mountain West heritage. Distinctive styles created from quality fabrics, silhouettes perfected with just the right drape, feel-good fits offering ease of movement, and thoughtful details to elevate your look. Coldwater Creek's authenticity is embodied in every piece, embracing its confident spirit that carries through to today. Discover Coldwater Creek clothing, designed to fit your life the way you want. For a wardrobe you can count on season after season, visit coldwatercreek.com. Shop the new spring collection at 20% off $75 or more with code IHEART20.
Ever feel like your bedroom's shrinking? Don't worry, you don't have to sell your favorite things to make space. With IKEA Bedroom Storage Solutions, think dressers, wardrobes, full closet systems, even storage boxes. You can keep it all. Your vintage band tees? Safe. Those limited edition sneakers? Plenty of room. And yes, your childhood teddy bear gets a spot too. Don't sell what you love. Store it instead with IKEA Bedroom Storage Solutions. Shop now at ikea.us/bedroom storage.
This is an iHeart podcast. Guaranteed human.